Long before insurance was formalized anywhere in the world, African societies had developed rich and sophisticated systems of communal risk sharing rooted in a philosophy that made such arrangements not merely practical, but morally obligatory. The values underlying this philosophy evolved and spread when Proto-Bantu speaking peoples began their great migration from West Central Africa towards Southern Africa approximately 5,000 years ago, around 3000 BC, making African communal risk traditions roughly contemporaneous with the earliest Chinese merchant practices on the Yangtze River. Chinese traders transporting goods along the Yangtze River understood a simple and terrifying truth. Any single boat could capsize, and losing an entire cargo in one disaster could ruin a merchant completely. Their ingenious solution was to distribute their goods across multiple vessels. If one boat went down, no single trader lost everything. Each absorbed only a fraction of the total loss. This principle, spreading risk among many so that no one bears the full weight of catastrophe alone, is the foundational idea upon which all of insurance history is built. These ancient Chinese merchants did not call it insurance, but what they practiced was its purest expression. Nearly 1,000 years later, in ancient Babylon, risk sharing took on the force of law. Around 2100 BC, King Hammurabi of Babylon codified one of the earliest and most comprehensive legal systems in human history, inscribed on a towering black diorite obelisk now known as the Code of Hammurabi. Among its nearly 300 laws were provisions directly relevant to the protection of merchants against loss. Under what were known as bottomry loan agreements, a merchant could borrow money to finance a trade voyage. Crucially, if the ship was lost at sea or the cargo seized by enemies, the merchant was absolved of the obligation to repay the loan. The lender, in exchange for charging a higher rate of interest, accepted the risk of total loss. In essence, the lender was providing something very close to what we would today recognize as maritime insurance. The Code of Hammurabi transformed informal risk-sharing arrangements into legally enforceable contracts, marking a profound step forward in the development of insurance as an institution. As classical civilization gave way to the early medieval period, a new structure emerged that formalized mutual protection among communities of workers and tradespeople, the guild system. By roughly 400 AD, and continuing through much of the medieval era, guilds, associations of craftsmen, merchants, and artisans organized around a common trade, began establishing funds to assist members in times of hardship. If a guild member's workshop burned down, if he fell gravely ill, or if he died and left behind a family, the guild would draw upon its collective resources to provide relief. Members contributed regularly to these communal funds, and the funds existed precisely to be drawn upon when misfortune struck. This was, in practical terms, a primitive form of both property insurance and life insurance, administered not by a distant corporation, but by a tight-knit community of peers. The guild system demonstrated that the pooling of resources for shared protection was not merely a clever financial arrangement, but a moral obligation, a form of brotherhood expressed in economic terms. The medieval period also saw the continued development of financial instruments specifically designed to manage the dangers of maritime trade. Two instruments were especially significant: sea loans and commenda contracts. A sea loan functioned similarly to the bottomry loans described in the Code of Hammurabi. A lender advanced money for a voyage and bore the risk of loss at sea in exchange for a higher return if the voyage succeeded. The commenda contract was a partnership arrangement in which one party provided the capital for a trading expedition and another provided the labor of actually making the voyage. Profits and risks were divided between them according to agreed terms. Both arrangements allowed merchants to undertake risky voyages without staking their entire fortune on a single journey, and both represented the continued ingenuity of medieval commerce in managing uncertainty. These contracts would eventually evolve into something recognizable as a formal insurance policy. The next great milestone came in 1347 in the bustling port city of Genoa, one of the great commercial powers of the medieval Mediterranean. It was here that merchants and notaries developed what is widely regarded as the first written marine insurance contract in history. Unlike the earlier sea loans, in which the lender both provided capital and absorbed risk, this new instrument separated the two functions cleanly. A merchant who wished to insure a cargo would pay a premium to an underwriter, who in exchange promised to compensate the merchant for losses at sea. The underwriter did not lend money, he simply accepted risk in exchange for a fee. This distinction was crucial because it created insurance as a standalone product rather than a feature embedded in a loan. The Genoese merchants, drawing on centuries of accumulated experience with maritime trade and financial innovation, had created a model that would endure, with refinements, for the next 7 centuries. By the early 15th century, the practice of formalizing insurance arrangements continued to evolve through instruments known as Cambion contracts, sophisticated financial agreements that further refined how risk could be transferred and priced among parties. These contracts reflected the growing complexity of European trade networks and the increasing demand for financial instruments that could protect merchants operating across long distances and unpredictable seas. They represent an important link in the chain from the earliest Genoese policies to the more systematic underwriting practices that would emerge in subsequent centuries. A landmark moment in the intellectual history of insurance came in 1488 with the work of Pedro de Santarém, a Portuguese jurist. Santarém authored what is considered the first known scholarly treatise specifically dedicated to the law of insurance. His work, written in Latin and later published in 1552, examined the legal principles governing insurance contracts, their validity, and the obligations they created. By subjecting insurance to rigorous legal analysis, Santarém helped establish it not merely as a commercial custom, but as a recognized legal institution with its own body of doctrine. His treatise signaled that insurance had grown complex and important enough to warrant systematic intellectual treatment, a sign of its maturity as a practice. Woven into the history of insurance is the parallel development of the mathematical tools needed to price risk rationally. The French mathematician and philosopher Blaise Pascal made contributions that, while not directed at insurance specifically, proved foundational to the actuarial science that underpins all modern insurance. Pascal's triangle, a triangular arrangement of numbers in which each number is the sum of the two directly above it, provided a systematic way of calculating probabilities and combinations. Together with his work on probability theory, conducted in correspondence with fellow mathematician Pierre de Fermat in the 1650s, Pascal helped establish the mathematical framework for understanding the likelihood of future events. Insurers, to price their products correctly, must estimate the probability that a loss will occur. Pascal's contributions gave them, and the actuaries who would follow, the intellectual tools to do so with rigor rather than intuition alone. On September 2, 1666, a fire broke out in a bakery on Pudding Lane in the city of London. Within days, it had consumed over 13,000 houses, 87 parish churches, and St. Paul's Cathedral, leaving roughly 70,000 of London's 80,000 inhabitants homeless. The Great Fire of London was an urban catastrophe of almost unimaginable scale, and it revealed with brutal clarity the complete absence of any organized system for compensating those who lost property to fire. In the decades that followed, the disaster galvanized entrepreneurs and civic thinkers to create just such a system. By 1681, formal fire insurance offices had been established in London, offering property owners the ability to pay premiums in exchange for compensation if their homes or businesses burned. The city's buildings were marked with fire marks, metal plaques identifying which insurance office covered each property, so that the private fire brigades employed by these companies would know which properties they were obligated to protect. The Great Fire, in its terrible way, was the event that made fire insurance not merely desirable, but urgently necessary, and London's entrepreneurs rose to meet that need. Just 2 years after the establishment of formal fire insurance, another institution took root in London that would become the most famous insurance marketplace in the world. In 1688, Edward Lloyd opened a coffee house near the Thames waterfront, a natural gathering place for sailors, merchants, and ship owners who came to exchange news and conduct business. Lloyd's Coffee House became a regular meeting point for those who wished to arrange marine insurance, and the practice that developed there was elegantly simple. A merchant seeking to insure a vessel would circulate a document describing the ship and the voyage, and individuals willing to accept a portion of the risk would sign their names beneath the description, writing under the stated terms, which is the origin of the word underwriter. Each underwriter accepted liability for the share he signed for, and together they covered the full risk. Over the following decades and centuries, this informal arrangement evolved into the formal institution known as Lloyd's of London, which today remains one of the world's premier insurance and reinsurance markets. It is a remarkable testament to the power of a simple, transparent mechanism for distributing risk. To understand the full history of insurance, one must confront one of the most morally catastrophic chapters in the industry's story, a chapter in which the same mechanisms developed to protect merchants from the loss of goods were applied, with cold commercial logic, to the ownership and transport of human beings. Slavery was not merely a labor system, it was also a financial system, and insurance was one of its essential instruments. From 1640 to the early 19th century, an estimated 3.1 million enslaved African people were transported by Britain's vast shipping industry, and Lloyd's of London was the global center for insuring that industry. Enslaved people were insured as goods, a classification that researchers have identified as evidence of the dehumanizing commodification of and speculation on the financial value of enslaved lives. The surviving risk books of 18th century Lloyd's underwriters Horatio Clagett and Solomon d'Aguilar reveal the everyday mechanics of this trade. The Guipuzcoa insurance agreements, named for the slave ship they related to, fix the value of an enslaved person at 45 pounds, equivalent to approximately 3,454 pounds in today's money, and contain a clause unique to slaving voyages, under which underwriters would cover damage to the ship or any devaluation of enslaved people, including death due to insurrection across the Atlantic. American insurance companies were building parallel systems of profit from enslaved lives. New York Life, between 1846 and 1848, sold policies on the lives of enslaved people, providing compensation to slave owners upon the enslaved person's death. In the span of just those 2 years, the company sold 508 such policies, more than Aetna and U.S. Life combined, before ceasing the practice in 1848, under pressure from the growing abolitionist movement and the financial reality that death claims were consuming nearly as much as the policies were generating. Aetna, founded in 1853, sold policies from shortly after its founding through at least 1858 that reimbursed slave owners for financial losses when the people they enslaved died. These policies were particularly common for enslaved people whose labor was especially dangerous. Aetna, New York Life, and U.S. Life all sold insurance policies to slave owners whose laborers engaged in hazardous work in mines, lumber mills, turpentine factories, and steamboats in the industrializing sectors of the South. The enslaved person's life was insured not for the benefit of that person or their family, but entirely for the financial protection of the person who claimed ownership of them.